So you're thinking about investing in property, but you're stuck on a classic question. Should I buy a house, a townhouse, or an apartment? They're all over the market, all at different price points, and all seem to offer something different. But when it comes to building long-term wealth, one stands out, and it's mostly thanks to land. Let's unpack the pros and cons of each and what investors need to look out for, especially if you're serious about capital growth. First, houses. The capital growth king. Houses sit on their own block of land, and that's the key. Over time, the land is what appreciates. The actual building depreciates as it ages. So when you invest in a house, especially in an established suburb with strong demand, you're really investing in scarcity. There's only so much land, and that's what drives growth. Yes, houses often have the highest upfront cost and lower rental yields, but they're usually the best performers for capital gains. If your goal is to build equity and scale into more investments, houses should be on your radar. Number two, townhouses, the middle ground. Townhouses are a great in-between option. You usually get a small land component, maybe a courtyard or a bit of front yard, and you often own the land it sits on. Even if it's shared under strata, they're generally more affordable than houses, easier to maintain, and can still offer solid capital growth, especially in tightly held suburbs. Townhouses work well for investors who want a balance of some land value for growth and a slightly stronger yield than a detached house. Just keep an eye on body corporate fees and how dense the development is. More units usually means less land per dwelling. Apartments are typically the most affordable entry point, and they can offer great yields, especially in inner city or high demand rental areas. But here's the catch. You don't own much of any land. You're mostly buying airspace and a share of common areas, meaning capital growth is limited compared to houses or townhouses. And here's something a lot of investors don't realize. If someone in your block sells their apartment for a lower price, maybe due to financial stress, a divorce, or just wanting a quick sale, it can drag down the perceived value of your unit too. Because all units in the same block are seen as near identical by banks and valuers, so one low sale can reset the benchmark. So, which one should you choose? Here's a simple way to think about it. Houses, higher capital growth, more expensive, but better long-term wealth builder. Townhouses, balanced growth and affordability and lower maintenance. Apartments, lower entry cost, good yields, but limited growth and higher risk of price suppression. If you're an investor focused on long-term capital growth, land should be a top priority. And that means houses or townhouses with a decent land component tend to outperform. Here's a 10-year growth comparison example. Let's say you buy each type of property today. First, the house grows 6 to 7% per year thanks to the land. The townhouse grows 4 to 5%, and the apartment grows only 2 to 3%, maybe even flat if oversupply hits. In 10 years, that compounding growth creates a huge difference in equity, and more equity gives you leverage for future investments. Now, that's not to say apartments are always a bad move. They can work as part of a yield-focused strategy or as an entry point into high-demand locations. But if you're in this to build wealth over time and you want compounding equity, remember this: land is the real asset. Buildings age, land appreciates, and that makes all the difference. If you have questions about which property type fits your goals, drop them in the comments, hit like and subscribe, and if you're ready to start investing, get in touch. We'll help you find the right strategy for your situation.